Welcome to Next Game Playbook. This is the show where we unpack strategies, insights, and tools to help creators, brands, and thinkers navigate their next big move. I'm Dax Nolan.
And I'm Naomi Kale. Yeah, we're here to cut through the noise, bring you compelling ideas, and maybe spark some new ways of thinking about the challenges and opportunities you face every day.
Today, Naomi, we're looking into something that, well, on the surface, it looks incredibly simple.
Right.
You know, the price tag on a product or the number on a service invoice.
Right.
It feels like it should be pretty straightforward. Just add up your costs, put a little profit on top maybe, and you're set. But what if those numbers, those seemingly simple figures, are actually one of the most powerful, really intricate strategic levers you have? What if they could reshape your whole business path way beyond just, covering expenses?
It's so true, Dex. What's really captivating here is how pricing goes way beyond just accounting, doesn't it? It fundamentally shapes your profitability, it carves out your market presence, it even dictates how customers perceive the actual value of what you offer. It's a foundational element of business success. But it's often underestimated, I think, in its true complexity and, frankly, its potential.
Yeah.
Many businesses, and this is something the insightful article, Pricing Strategies That Work, from Next Game Playbook really highlights, they often cling to just one method, maybe something overly simple, like just calculating costs and adding a margin.
The old cost-plus method.
Exactly. And by doing that, they might be bypassing a whole spectrum of more sophisticated and, let's be honest, potentially more profitable alternatives.
So our mission today, then, is pretty clear. We want to illuminate the core principles, explore the different models out there, and look at the modern optimization techniques that can transform pricing from just a calculation into a really potent dynamic asset. Our aim is to equip you, our listener, with the foresight to navigate this crucial part of any venture. Whether you're just starting out, laying the groundwork for a startup, or maybe you're fine-tuning the operations of a more established business.
Right.
We want to show you how pricing, when you approach it with real strategic intent, becomes a genuine engine for growth. So, okay, if you're a business owner or a creator, maybe an entrepreneur, and you're trying to pin down that perfect price point for what you offer, where do you even start? How do you gather the right intelligence?
Yeah, that's the million-dollar question, isn't it?
The article we're exploring today points to this crucial interplay, this kind of dance between your internal capabilities and the wider external market dynamics. It's never just one or the other.
Absolutely not. It's a constant, intricate dance, as you said.
So to really get a handle on this interplay, let's begin by looking inward first, at what's within a company's own control.
You're absolutely right, Dax. Understanding your internal landscape, your own operational reality, that's step one. It's non-negotiable.
Okay.
And at the very foundation, your company's main objectives, your big picture goals, they have to be the bedrock for all your pricing decisions.
Right. What are you actually trying to achieve?
Exactly. Think about it. Are you aiming for really aggressive market share expansion, even if that means, operating on thinner margins for a while?
Okay.
Or is your primary goal to maximize the profit you get from every single transaction? Maybe you're even in a survival mode, where the immediate goal is just to keep the lights on, sustain operations through a tough patch.
Sure.
Each of these core business goals, whether it's profit, growth, just long-term survival, or market dominance, it's going to naturally steer you towards a very different pricing philosophy.
Can you give us an example? How does that play out in the real world?
Certainly. Let's imagine a new tech startup. Their main goal is often rapid user acquisition, right? Establishing a big market footprint fast.
Get those users in the door.
Exactly. So to do that, they might consciously adopt a very aggressive lower price strategy, maybe even offering services below cost for a period, just to build up that user base quickly.
Right. Profit comes later.
Profit per user isn't the immediate focus. It's about capturing a significant slice of the market. Now, contrast that with, say, a well-established, mature company. They already have a strong market position.
Okay.
Their focus might be squarely on maximizing shareholder value. So they'd likely price their offerings to generate the highest possible profit, perhaps through premium positioning that reflects their established brand equity.
Like a luxury brand.
Or maybe through relentless efficiency gains that let them price competitively while still keeping strong margins. It's all about aligning your pricing with where you ultimately want to go.
That makes a lot of sense. Your overall company compass really does guide everything else. But okay, beyond those big strategic goals, there are the tangible realities, the costs involved in actually making your product or delivering your service.
Precisely. Product costs are the next vital internal factor. You absolutely need to meticulously account for both your fixed costs and your variable costs.
Okay, break those down for us. Fixed versus variable.
Sure. Fixed costs are those expenses that stay the same, pretty much regardless of how much you produce. Think of your annual office rent or the fixed salaries of your core admin team.
Right, they don't change month to month based on sales.
Exactly. They're there whether you produce 1 unit or 1,000. Variable costs, on the other hand, they fluctuate directly with the amount of goods or services you deliver.
So more sales means more of these costs.
That's right. This would include things like the raw materials for each product, the direct labor involved in making it, or maybe the shipping fees for each item sold.
So knowing your fixed costs like rent and variable costs like materials, that's not just basic accounting then. You mentioned cost structure leverage earlier.
Exactly, Dax. It is about leverage. Can you achieve economies of scale? Can you drastically lower your variable costs per unit as you produce more? Because that allows for more aggressive pricing strategies down the line.
Oh, okay.
Or maybe your fixed costs are so high that you have to hit a certain sales volume just to break even.
Right, that break-even point.
Understanding this tells you your minimum viable price point, regardless of what the market wants. It ensures you don't operate at a loss. Now, while your cost should never be the sole determinant of your final price, and we'll get into why shortly, you absolutely must know them cold, you have to know that floor.
You can't price strategically if you don't know where you start losing money.
Precisely. You can't fly blind.
And products themselves aren't static.
Right.
They change, they mature, they go through different phases. How does a product's life cycle impact what you can realistically charge?
That's another huge internal factor. A product's journey through its life cycle and how different it is from competitors has a profound influence on pricing.
Okay.
For products that are, say, in their early stage or are genuinely innovative, think a groundbreaking new technology or a totally unique service, you often have a significant advantage.
Because there's nothing else like it.
Right. These can often command higher initial prices. There's a strategy for this, actually, called price skimming. It works because of the novelty, the distinct features, or simply the lack of direct competition.
Early adopters paying a premium.
Exactly. They're often eager and willing to pay more to be among the first.
But that doesn't last forever.
No, it doesn't. As products mature, they inevitably face more pricing pressure. The market gets crowded, competitors pop up with similar offerings, and the product can start to feel, well, commoditized.
Like everyone's selling basically the same thing.
Mm-hmm. At that mature stage, your pricing might need to become much more competitive, or your focus might shift towards adding value in other ways, better service, unique bundles, rather than just relying on the core product's price. It's a constant adaptation.
And I guess where you sell it and how you sell it.
Yeah.
That must add another layer of complexity too. Online versus retail, different regions.
Absolutely. Your distribution channels and the specific geography of your market play a really significant role. The price you set for a product sold directly on your website, for instance, could be quite different from the price needed when it's sold through a traditional brick-and-mortar store.
Why is that? More middlemen.
Essentially, yes. The retail channel introduces extra costs, wholesale markups, maybe slotting fees to get on the shelf, other channel-specific expenses that have to be factored in.
Right.
And similarly, regional differences can demand different pricing. You might have higher shipping costs to remote areas or face different local demand based on cultural or economic factors. Plus, you've got varying taxes, import duties, all impacting the final price.
Can you give a quick example?
Sure. Imagine a highly specialized industrial part. It might be priced much higher in a remote region where it's hard to get and shipping is expensive compared to a major industrial hub where supply is plentiful and logistics are efficient.
Gotcha.
These aren't just tiny tweaks, they're fundamental things that can seriously affect your profitability in different markets.
Okay, so that covers a lot of ground on the internal side. What you can control, or at least directly influence your goals, costs, product stage, distribution. But like you said, no business is an island. It's like you're trying to set your own rules, but the bigger game, the market, it has its own powerful forces. And this is where it gets really interesting, I think. How much power does the outside world really have over what you charge? Can you ever really ignore it?
That's exactly where external factors come into sharp focus. And honestly, they're often just as critical, maybe even more so, for really strategic pricing.
Okay, like what? What's the biggest external force?
The first big one we have to consider is market demand and price elasticity. That sounds a bit technical, but it's really just about how sensitive your customers are to changes in your price.
Okay, sensitive how?
Think of it this way. If you sell something essential, like, say, a critical medicine, and you raise the price by 10%, will demand drop off a cliff? Probably not dramatically, right? People need it.
Right, they'll pay it if they have to.
That's what we call inelastic demand. You have more flexibility to adjust prices without seeing a huge drop in sales volume.
Okay, inelastic. So customers will mostly just accept a price hike there.
Largely, yes. Within reason, of course. But now, think about the opposite. Maybe a luxury gadget or something discretionary like a concert ticket.
Something you want, not need.
Exactly. If you raise the price of that concert ticket by 10%, will customers suddenly look for cheaper entertainment? Or maybe just decide not to go, wait for a sale.
Yeah, probably.
That's elastic demand. Even a small price increase can cause a big drop in demand because customers have alternatives, or they can just put off buying it.
So knowing if you're selling something elastic or inelastic is crucial.
It's like having a superpower for predicting how sales will react. It's not just about sensitive customers, it's fundamentally about how easily your product can be substituted and how essential it really is. Knowing this is absolutely critical. You need it to avoid underpricing, just leaving money on the table, or overpricing, accidentally scaring your customers away.
Okay, so you need to figure out if your customers will just shrug off a price change or run for the hills. And of course, you're not alone out there. Your competition isn't just sitting still either.
Absolutely not. Competitor pricing is another huge external factor. You have to be acutely aware of what your rivals are doing, what are they charging, what value are they claiming to offer, how are they positioning themselves.
So just copy them.
No, definitely not. That's a trap. Blindly mirroring competitor prices often leads to that destructive race to the bottom where everyone just keeps cutting prices and profit margins vanish for the entire industry.
Right, nobody wins there.
Nobody wins. Instead, it's about using that information strategically, maintaining relevance, positioning your own product effectively.
So knowing what they charge helps you decide your own position.
Exactly. If your product genuinely offers better features, higher quality, maybe amazing customer service, you might confidently justify a higher price.
Makes sense.
Conversely, if you're trying to break into a really crowded market, you might need to be more aggressive initially to carve out some space. The key insight here is understanding the whole competitive landscape. That allows you to make sure your pricing strategy is sustainable and helps you capture or defend your market position. It's about being informed, not just reactive.
And beyond your direct competitors, the ones selling similar stuff,
Yeah.
what about the bigger picture? The overall economy, government rules?
Oh, yeah, the economic climate and regulations definitely have a significant impact. Broader economic conditions, like a period of high inflation, can dramatically increase your own costs. That might force you to rethink your pricing just to maintain your current profit margin.
Right, everything's getting more expensive.
And conversely, during a recession, people naturally become more price sensitive. Businesses might feel pressured to offer discounts or lower prices just to keep demand up.
And government intervention, taxes, rules.
Absolutely. Governments often impose various controls, taxes, regulations that directly hit pricing. Think standard sales taxes or excise duties on things like alcohol or tobacco. But sometimes it's more direct, like price ceilings on essential goods during a crisis, to protect consumers.
So they set legal limits.
Effectively, yes.
Ugh.
These regulatory frameworks establish legal pricing floors and ceilings. They define the boundaries you have to operate within. Ignoring them is simply not an option.
Okay, finally, Naomi. We talk a lot about the tangible stuff, features, costs, competitors, but what about the psychological side? How customers actually feel about the price you set? It seems like it's more than just numbers on a page.
You've hit on such a crucial point, Dax: customer perception. It's arguably one of the most potent, yet often overlooked, external factors. Price is an incredibly direct, powerful signal of value.
How so?
Well, when a premium price is genuinely backed up by high-quality, superior features, maybe exceptional service, it can actually boost how people see your brand.
Interesting. So higher price can mean higher perceived quality.
It absolutely can. It communicates exclusivity, desirability, often an implicit promise of excellence. Think about well-known luxury brands. Their prices aren't just about covering costs. They're carefully crafted to signal status, craftsmanship, and superior quality.
But it has to be justified.
Exactly. The inverse is just as true. If a high price isn't convincingly justified by that perceived value, it can quickly lead to skepticism, resentment. Customers might just reject it outright.
Which brings us back to, how do you shape that perception?
Right. It's a continuous effort. It involves consistent brand messaging, unwavering product quality, and crucially, consistently delivering on the promise that your price implies. It's really about building trust, one interaction, one transaction at a time.
Okay, now that we've sort of mapped out the terrain, the internal factors within your control and the external forces pushing and pulling, let's pivot to the actual strategies, the specific tactics.
hmm
The article we're digging into lays out 7 distinct approaches. Each one has its own formula, its best use cases, and things to watch out for. Think of this next part as your practical handbook, your toolkit for pricing.
Exactly. And these strategies aren't always used in isolation, but understanding each one individually is really the essential first step. So let's start with maybe the most basic one.
Okay.
One, cost plus pricing. The formula here is, well, it seems straightforward. You figure out your total cost to make the product or deliver the service, and then you just add a set percentage markup for profit.
Right. Cost plus markup, price. Sounds incredibly simple, almost too easy. What's the catch? Is it really that straightforward?
It is simple, and its main advantage is clear.
Okay.
It guarantees you cover your costs and make a predictable profit margin.
That's why it's popular.
So it's safe. In a way, it's particularly useful in industries like manufacturing, wholesale, or maybe for custom-made goods where your costs are pretty clear and stable. But the big catch, the major drawback, is that it completely ignores what's happening outside your walls. It ignores market conditions and, crucially, what the customer actually perceives as value.
Can you give an example of that downside?
Sure. Imagine a talented furniture maker who crafts beautiful, bespoke pieces. If they only price based on the cost of the wood and their labor hours, they might completely miss the huge value a customer places on the unique design, the artistry, the story behind it.
So they cover costs but miss out on potential profit.
Exactly. They're covering costs, sure, but they could be leaving significant profit and that perceived value untapped. A competitor, maybe even one with higher costs, might capture that extra value simply because they understand the customer's desire for uniqueness and craftsmanship. Cost Plus tells you what you need to charge, but not necessarily what you can charge or what the market will truly support.
Okay, so strategy number 2 must be different then.
2. Value-based pricing. Yes, this one takes a fundamentally different approach. Here, the price isn't anchored to your internal costs at all. Instead, it's determined by the customer's perceived value of your product or service.
Perceived value, we talked about that.
Right. This approach is really effective for things like software as a service, SaaS, luxury goods, high-end consulting, specialist design agencies. Basically anywhere, the intellectual property, the unique solution, or the transformative benefit provides massive, often quantifiable value to the client.
What are the upsides?
The advantages are significant. You can often command much higher margins, and you tend to build stronger, more loyal customer relationships because people feel they're getting something genuinely worth the investment.
But it sounds harder to implement.
It is. The challenge is that it demands really intensive, ongoing customer research to truly understand what they actually value. And you need a constant commitment to innovation to keep that perceived value high.
So how do you figure out perceived value? It sounds subjective.
It can be, which is why the article emphasizes things like regular customer surveys, in-depth interviews, really listening to feedback. You can't just guess. You have to actively engage, listen, observe how customers behave and what they say.
Okay, strategy 3.
3. Competitive pricing. As the name suggests, this involves setting your price mainly by looking at what your direct competitors are charging.
This feels like the go-to for so many businesses. Retail, fast food, online stores. Is it a safe bet, or is there a hidden danger?
It often feels like the default because it offers easy benchmarking. You know you're in the ballpark, right? You're not wildly over or underpriced compared to your rivals. It's common in really competitive sectors, e-commerce, ride-sharing apps, restaurants.
Yeah.
But the hidden danger, the big risk, is triggering that race to the bottom we mentioned earlier.
Where everyone just keeps undercutting each other.
Exactly. Companies continuously lower prices to match or beat the competition, and everyone's profit margins just get squeezed. The smart way to use this, as the article suggests, is as a reference point, a context, not your sole guide. Your unique value, what makes you different, should always be the focus, not just what the other guys are charging. Use their prices to inform, not dictate.
Got it.
Okay, number 4.
4. Price skimming. This is a more sophisticated strategy. It involved launching a new product at a deliberately high initial price to capture maximum revenue from early adopters, and then gradually lowering the price over time.
Like new iPhones or game consoles.
Precisely. It's ideal for innovative tech products or maybe luxury launches where that initial exclusivity really matters. The benefits are pretty clear. You can get a quick return on your R&D investment.
Which can be huge for tech.
Absolutely. And it boosts that feeling of brand exclusivity. It appeals directly to those who want the newest thing and are willing to pay for it.
What's the downside? Well, that high price advantage is often short-lived. As the market gets used to the product or as competitors emerge, you inevitably have to lower the price. So the pro tip here is twofold. First, you really need to communicate the premium value clearly from day one to justify that high launch price. Second, you need to plan those price drops strategically, maybe timed with new model releases or wider availability, so it feels like a natural progression.
Okay, that makes sense. What's next?
Hive, penetration pricing. This is essentially the opposite of skimming. You introduce a product at a deliberately low introductory price, aiming to quickly gain significant market share.
So grab as many customers as possible, fast, like streaming services often do.
Exactly. It's a strategy designed for rapid growth. The advantages are quick customer acquisition and getting your brand name out there widely. It's powerful in markets with network effects like streaming or telecom or even new food and beverage brands fighting for shelf space.
This sounds like a really fast way to grow. But what's the hidden cost? Is there a catch?
There is. The most obvious cost is very low initial profits by design. And there's a real risk of brand dilution. If customers get used to seeing your brand as the cheap option, it can be incredibly difficult to raise prices later without backlash.
People might feel ripped off later.
Potentially.
Yeah.
And thinking bigger picture, this strategy puts huge demands on your operations. You must have the infrastructure ready to scale up production and support very quickly. If you get a sudden surge in demand you can't handle, you risk creating a poor customer experience, which can completely undermine the initial gains.
Right, you need to be ready for that success. Okay, number 6.
6. Dynamic pricing. This is a really sophisticated one. It means adjusting prices in real time, sometimes constantly, based on factors like current demand, inventory levels, even individual customer behavior patterns.
Like airline tickets or hotel rooms.
Yeah.
The price changes all the time.
Exactly those. Airlines, hotels, big e-commerce sites like Amazon, event ticketing, they all use dynamic pricing extensively. The big advantage is maximizing revenue. You capture the highest price the market will bear at any given moment, and you can adapt instantly to changes.
But it can feel unfair sometimes, right, as a customer?
It definitely can. That's the main drawback, besides the complex technology needed to run it. There's a real potential for customer frustration if the price changes seem arbitrary or exploitative.
So how do businesses use this without alienating everyone?
That's the key question. The article suggests using sophisticated tools, often powered by AI, for automation and optimization. These tools can manage the complexity and, importantly, help maintain a sense of fairness, maybe by operating within defined rules or limits rather than making completely unpredictable jumps. Transparency helps too.
Okay, that leaves one more. Number 7.
7. Freemium pricing. This is a model many people are familiar with now. You offer a basic version of your product or service completely free, but you charge for premium features, extra functionality, or maybe an ad-free experience.
Super common for apps and software, like Spotify or Canva.
Yeah.
But does it work for everyone? Is it sustainable long-term?
It's incredibly common, especially in SaaS, media, and apps, as you said. The huge advantages are the potential for viral growth. It's easy for people to try it with no risk and very low customer acquisition costs initially. You get users first, then try to convert them.
But conversion must be the hard part.
That's exactly the challenge. Sustainability often hinges on converting enough free users to paid subscribers. Conversion rates can be quite low, leading to revenue challenges if you're not careful.
So what's the key to making freemium work?
The absolute necessity, and the article stresses this, is clearly differentiating the free and paid versions. The free version needs to be good enough to attract users and show value, but limited enough that there's a strong, compelling reason for people to upgrade to the premium tier. Otherwise, you risk just giving away too much value for free without getting enough paying customers to support the business.
Okay, Naomi, wow. That's an incredible toolkit of strategies, 7 really distinct ways to think about pricing. But, as you mentioned, and the article really emphasizes this, the most successful companies often don't just pick one strategy and stick with it forever. They blend them. They mix and match. Why is that combined approach so powerful?
Yeah, the power of these hybrid models really comes down to synergy and adaptability. You're right. No single strategy is a magic bullet for every situation, every product, every market, every stage of a business.
Right.
By skillfully blending different approaches, companies can often tackle multiple goals at the same time, even goals that might seem contradictory.
Like growth and profit.
Exactly. The article gives some great examples. Think about Netflix. They started out using classic penetration pricing, right? Super low introductory rates to get subscribers fast and dominate the early streaming market.
Yeah, I remember that.
But once they were established, they shifted. They moved into tiered subscription plans. That's effectively combining that initial penetration push with a more nuanced kind of value-based pricing. Higher tiers offer more streams, better quality, catering to different needs and willingness to pay.
And Apple. They seem like masters of premium, but they mix it up too.
They absolutely do. Apple is famous for premium, but they consistently use price skimming for new product launches. When a new iPhone drops, it hits the market at a high price, grabbing those early adopters who crave the latest tech.
Capturing that initial excitement.
Precisely. Then, over time, as newer models come out, the prices of the older ones gradually decrease. This lets them capture different segments of the market, people with different budgets, so that initial skimming blends into a sustained premium pricing model across their whole ecosystem, constantly reinforcing that high-value perception.
And Amazon feels like they use almost everything in the playbook.
Amazon is a fascinating case study in multi-strategy integration. They are masters of dynamic pricing, prices changing constantly based on demand, inventory, competitor moves.
Yep, you see that all the time.
But they combine that with aggressive competitive pricing on millions of items, often trying to be the lowest price option. And then they layer on bundle pricing, offering deals if you buy multiple things together, which boosts the average order value and makes customers feel like they're getting a better deal.
So they're using dynamic, competitive, and bundling all at once.
This masterful blending lets them maximize revenue across an unbelievable range of products and customer types. The big takeaway here really is adaptability. The mix of strategies you use shouldn't be static. It should evolve with your product's life cycle, be tailored to specific market segments, and shift based on changing customer expectations. It's a living part of your business strategy.
Okay, so choosing the right strategy or the right blend is one thing, but actually making it work day to day, making it stick, that's another challenge. What are some of the best practices for actually implementing and then optimizing your pricing? And maybe more importantly, how do you know if it's actually working?
Great question. Effective implementation really requires careful attention to detail. First off, communicate clearly. Transparency is absolutely fundamental for building trust. Avoid hidden fees, surprise charges, any kind of bait and switch. That stuff erodes trust incredibly quickly.
Yeah, nobody likes feeling tricked.
Nobody. Second, think about leveraging pricing psychology, but ethically. There are simple techniques that can subtly influence perception without being deceptive. We mentioned charm pricing earlier, the $9.99 instead of $10 trick. It still works psychologically.
Still feels cheaper.
It does. Then there's anchoring. That's where you show a higher priced option first, which makes the subsequent lower priced options seem more reasonable by comparison.
It's a reference point.
Exactly. And bundling, like we saw with Amazon, offering multiple things together for a lower combined price often feels like a much better deal than buying them separately. These aren't tricks, really. They're about framing value intelligently.
Okay, so you've implemented your strategy, you're being transparent, maybe using some psychology. How do you measure the impact? How do you know if it's actually improving things? What numbers should you be watching?
Measuring what matters is absolutely critical. You need key performance indicators, KPIs, to really track performance. The article points out several crucial ones.
Like what?
Well, the basics first. Revenue growth rate and profit margin. Are sales going up? And are you keeping a healthy slice of that revenue after costs?
Obvious ones, but essential.
Absolutely. Then revisit price elasticity. Is demand reacting to price changes the way you expected? Are small tweaks having the predicted effect on volume?
Checking your assumptions.
Right. Also, market share. Are you gaining ground or at least holding steady in your market? This is especially key if your strategy is focused on growth, like penetration pricing.
Makes sense. What else?
Two really important related metrics. Customer acquisition cost, TACI. How much it costs to get a new customer, and customer lifetime value, CLV. How much revenue that customer brings in over their entire relationship with you.
You want CLV to be much higher than CATs.
Ideally, yes, significantly higher. Effective pricing should help ensure that. Then there's churn rate. how many customers are leaving, especially if you see a spike after a price change. That's a huge red flag. It tells you your perceived value might not align with your new price.
A warning sign.
A big one. And finally, average revenue per user, ARPU. This gives you a granular look at how much revenue each customer is generating, which is great for tracking the effectiveness of, say, tiered pricing or upselling efforts.
Wow, that's a lot to track.
It is, but Dax, are you consistently tracking these? And if you're listening, are you? If not, how can you really know if your pricing is effective or if you're just guessing? Without this data, meaningful optimization is basically impossible.
It really sounds like so much of this comes back to deeply understanding your customers and your market. And that means data, right? How do businesses actually get the insights they need to keep refining their pricing approach?
Leveraging data is absolutely the engine of continuous optimization. One really powerful technique is A/B testing your pricing.
Trying different prices on different groups.
Exactly. You strategically show different prices or maybe different pricing models like a subscription versus pay-per-use to different segments of your audience. Then you watch closely to see which approach performs better, whether that's higher conversion rates, more total revenue, or even better customer satisfaction scores. It's a direct, empirical way to see what actually works in the real world.
Takes the guesswork out.
It does. And beyond A/B testing, advanced analytics tools are invaluable, especially now with AI becoming more accessible. These tools can track complex sales trends, monitor competitor prices automatically, even help predict shifts in demand based on loads of different factors.
So you can be proactive, not just reactive.
That's the goal, making proactive adjustments based on data. And finally, always calculate the return on investment, ROI, for any significant pricing change you make.
What does that involve?
It means carefully weighing the short-term costs. Maybe a temporary dip in revenue during a promotion against the expected long-term gains, like increased market share, better brand perception, or higher customer lifetime value. It's about making strategic choices, thinking about the whole picture, not just the immediate impact.
So Naomi, let's try to wrap this up. What's the big picture takeaway here? We've gone from basic costs and internal goals through market forces and competitor actions, looked at 7 specific strategies, and talked about blending them and constantly optimizing. It seems overwhelmingly clear that pricing isn't just a number you set once. It's alive.
It really is, Dax. Strategic pricing is absolutely a dynamic, data-driven process. It's not a one-and-done decision you make and then forget about. Each of those models we discussed offers unique strengths, and as we saw, combining them thoughtfully often unlocks even greater potential. But ultimately, real, lasting success comes from truly understanding your specific market, getting inside your customers' heads about how they perceive value, and knowing what makes your brand unique and compelling.
Connecting the dots.
Exactly. Zooming out, it's all about aligning your pricing with your big business goals, keeping up with what customers expect, and being realistic about what your operations can actually handle. The key really is continuous testing, staying flexible, and always considering the long-term ripple effects of your pricing choices across the entire business.
So here's a final thought for everyone listening. Given the incredible power that pricing holds, how might rethinking the price of just one of your products or services, but doing it through this kind of fresh strategic lens, how might that redefine your whole approach to the market? And maybe more intriguingly, what untapped value might you discover you've just been leaving on the table all this time? That brings us to the end of this really fascinating discussion on pricing strategies. We certainly hope it's given you some new perspectives for your own next move. If you found this conversation valuable, please do consider liking the episode, maybe share it with a colleague or friend who could benefit, and definitely subscribe to our channel for more insights like this.
Yeah, and you can also head over to nextgameplaybook.com to find the full article we based this on, pricing strategies that work, plus a lot more in-depth resources. We genuinely love to hear your own thoughts or experiences with pricing, what's worked for you, what hasn't, so please leave us a comment below. And for ongoing updates and maybe some exclusive content, make sure you subscribe to our newsletter.
And while you're thinking about strategy, you might also find our previous discussion.
We release new episodes of Next Game Playbook every week, exploring everything from market entry tactics and growth hacking techniques to personal branding strategies and the challenges of scaling innovation.
So until next time, keep innovating, keep learning, and keep playing your next game.